Recording in progress.
All right, let's get a sound check real quick. Just I changed a few things, and I want to make sure everybody can hear me. That way I don't find out later on. All right, thanks, Nicole. I appreciate that. All right. So the market seems to believe that the Fed is going to pivot. It's we've got a showdown happening, only to a degree though, right? We had already moved a long ways. Everybody was expecting a little bit of a reversion back to the mean anyways. And it was just an offhanded comment that started this. And we've seen it before. Um, it's kind of a little bit of a chain reaction. A Fed speaker says something like, sure, I think we may be possibly moving a little quickly or a little aggressively with our rate hikes. That little sentence right there. Then the media will run over to another Fed speaker and say, oh, hey, Joey just said you guys are moving too fast. What do you think? Is it possible that you're moving too fast? Of course, he's going to say, well, it's possible. And no matter what he says after that sentence, that won't make a headline. Only, sure, it's possible we're moving too fast. And they'll run right to the next one. Hey, we got two Fed speakers who say we're moving too fast. What do you think? Are they right? And of course, they're not going to say they're wrong, that it's possible they're moving too fast. And it's just this chain reaction, right? That doesn't really go anywhere, and it doesn't give any guidance on is the Fed going to pivot. And I had thought the Fed made it very clear we're not going to pivot. 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 Right? So they're not going to pivot. Here we are looking at the Fed funds projection. Right? This is where what they're doing is tracking these futures contracts and looking at how those contracts are traded to identify where the market believes, what the market believes the Fed is going to do at the next rate hike. So right now we're sitting at 300, and there's a possibility that we get a 50 basis point rate hike or a 75 basis point rate hike. Now this one's not the one being really contended or debated, right? It's not the November meeting. It's the December and February meeting. So this is where you want to kind of keep your eye on things. If these numbers really start to shift between what it was one day ago and what it was today, and the February as well, December and February, and looking at where it was a week ago is useful, right? It kind of provides some context, but looking at what we had one day versus the next is going to be just as important. Now it's early in the morning, so looking at yesterday's and how much it's changed this morning, well, that was overnight trading, right? So you want to look at it through our trading day and see if this begins to widen even farther. It's going to show that they're perhaps unwinding a little bit of this, right? If they had already begun to price in a 75 basis point rate hike and now they suddenly believe that we could pause and or that we might only get a 25 basis point rate hike, then they're going to start to unwind this one, right? That big bar. All right, so like we do every day, we want to start with what happened around the world, see who's going to be on the docket to talk today. And as you can see, we have a lot of Fed speakers on the docket. Now, there's a little bit of risk here, right? Since a Fed speaker was taken out of context, and then the market now suddenly believes that a pivot is actually on the table and it's possible, one of these Fed speakers could give a reality check, right? Maybe throw some cold water on the whole thing. If they come out, like mic drop style, Jackson Hole 2022, and just straight up say, we're not going to stop and we're not going to pause and we're going to continue to hit you with 75 basis points all the way into 2023, that might do it. So kind of, be aware that the Fed is starting to lose control a little bit. They had finally convinced this market that they weren't playing around. And then somebody kind of put their foot in their mouth. So let's see if they're going to fix it or not. That is really important to this rally that we're looking at this morning, right? Because it's not the rally, right? The bottom's not in. A possible bottom, a bottom that could last for, between now and November 2, sure. But it's not the bottom. And it went global, by the way. Europe had a really great start to the fourth quarter as well. When it comes to quarterly earnings cycles, keep in mind that we've had all these different bubbles pop, right? And the bubble that is being focused on right now is earnings bubble. These earnings are just completely out of whack. And getting them priced back down into a more normalized way is kind of the goal. And I've heard it said in a way that like third quarter was the last good one you're going to see for a while, and that coming into the fourth quarter, more and more companies are going to be reporting the pain, right? And things are going to get a lot worse from there. But there's an if to that, because they had suggested that third quarter would start to show a lot of that pain, and yet earnings were really good, not across the board, but earnings were really good. So it kicks off with banks, and if the Credit Suisse is any example, banks are not going to perhaps do too good, and banks usually set the tone for the quarter. So if banks come out with a lot of pain at the front, then it's likely we're going to have a pretty painful quarter, and the bubble is going to get popped. They keep saying if it isn't this quarter, it'll be the next one. Well, that's what they said second quarter, and then it's what they said third quarter, and now we're getting into the fourth quarter. If it isn't this one, it's the next one. Eventually, possibly, maybe, right? So kind of just got to let that one play out a little bit. Yep, and one of the people listening to the stream this morning mentioned that Australia only raised by 25 basis points instead of 50, and thank you for that, by the way. And that kind of goes right into what we're talking about, right? That there's now this subtle hint that possibly maybe the Fed's going to blink. I'm going to take them at their word when they said that they're not going to blink, but I've been selling the rips, not buying the dips, but we just got to let it play out, right? The main thing is just trade what you got, and then when it rolls over or flips back, then okay, well, we'll trade that too. So looking at the S&P, we have this kind of a wedge down here, right? And we've got this top here on this wedge. A little bit like that. And one thing that you would probably want to do right off the bat is set out some levels. One of the great things about ranges and patterns is you can measure them and kind of mark out your 50% line, 25% line. I kind of mixed a couple of things together in this drawing set. It's the quant tool, but instead of having 25, 50, 75, 100, I used the 23.6, which is a fib level, and the 7.86, which is also a fib level. So I kind of tucked the Fibonacci inside of this thing. Then on the extension, instead of it only having 25, 50, 75, and 100, I put in the two fibs, my warning center in the 1, 2, 3, 6, and then the 50 and the 100. I didn't even bother with the 75. That way I don't have to draw things twice. Right? So the first area that we want to focus on is this 786 area. And the reason for that is a little bit of like a dead cat bounce, right? Markets don't move in a single direction. So when even in a downtrend, it needs to pull back. And we always want to kind of measure that pullback so that we can ask the question, is it really just a pullback, or has the market perhaps started to change direction and is actually going up? If it's just a pullback, the pullback shouldn't come back too far, quote, right? Not too far. Well, what's too far? 786. If you get into the CMT manuals and the certification process, they talk a lot about the 618. But I got to admit, it's really old material, right? Maybe in the 90s and the early 2000s, sharing data was a costly endeavor, right? It's thousands of dollars to have a internet that could even remotely provide you some kind of marketing data back then. And so people used 30-minute and 1 hour and thought they were pimping it back then, having 1 hour charts. Okay, right? But welcome to the real world, to the new days, where we can instantly share data around the world in massive size, and it's basically free. So instead of using the 786 as a drawback level, or 618, and saying if it crosses through that and closes on the other side of the 618, we consider the trend dead, I threw that out the window, and I used the 786. Because if you think about a pullback, right, if we're looking at a market headed to the downside, and we're getting that pullback now, do I really need it to go all the way to the 618 before I've decided that maybe it's gone a little too far to the backside? No. If it keeps going past this and keeps on going and closes way up here, I think I got the hint. It pulled back a little too far. Right? So 786, we don't want to see the market close above that level. If we do, then the downtrend that we've had since August, we would call that downtrend done, dead. Now, a trend that's dead can start again, so we can be in a downtrend. It can stop, it can die. The market can break it and then turn right back around and start moving back to the downside again in a whole new downtrend. Just because a trend has ended does not mean we're going to turn around and go the other direction, right? Or that the other directional move is going to continue. It just means the current trend that we are measuring is no longer valid, right? So kind of keep that in mind. Marking a trend dead does not imply anything. It just says that trend is dead. So that's what we're going to be watching for today. 3788 is kind of that line in the sand. We can go through it today, no problem. It's closing above it that matters. Right? So if we get to that level today, don't automatically assume that everything is done. It would be after the market closes today if we are still above 3788. And I got to say, at this point, we're close enough to it. Unless some news comes out this morning that turns things around, we're going to that level. Right? It becomes a little bit of self-fulfilling prophecy. We're going to that level. We'll want to reevaluate everything at that point. So we're going to just put a line up there. and I didn't cover it, but let's get it real quick. There are auctions today, both in the front end and in the back end. All right, so 11 and 11:30. These, to me, are really important. I know they don't get the coverage anywhere else, but they hold a lot of sway in my day. Every time that I see that we have additional auctions, I'm at the computer at lunch ready for an absolute change in market sentiment. We don't always get it, and a lot of times we don't get it. And that's fine. I don't care, because the times that we do get it makes it all worthwhile. All right, so watch the clock today at 11 and 11:30. JOLTS, if you're unfamiliar with this, it's another jobs number. This one's kind of cutely referred to as take this job and shove it. Think about during the 07-08 housing crisis when jobs were really scarce and it was hard to get a new one. Well, you kept the one you had, whether you liked it or not, right? Even if you hated it, you kept it because you had this fear that if you lost the one you had, you probably weren't going to find another one. So the JOLTS was low at that point. Then, say after COVID, when everybody was hiring like crazy and we had bargaining power on our wage, that was a great time to get a new job, right? And people had that freedom to tell a job that they didn't like, screw you, man, I quit. I don't like it here. I'm going to go find a better job where they'll possibly treat me better, right? So JOLTS, that's what it's recording. And it's easy to remember once you kind of put it into that take this job and shove it phrase. Like once I learned that, I never forgot what JOLTS was after that. The volume's not too bad this morning, right? We're sitting at around 200, well within the normal range. So that's all we needed to see. That it's not really, really low and that it's not really, really high. This looks very messy. So we're going to kind of clean this up a little bit. Aha. We have an MDP, that's a missed daily pivot. It's all the way down at 36, we'll call it 3660. It's a long ways below us. MDP is a trading strategy, not mine. I didn't make it. You can certainly learn more about it if you were to hit YouTube. So nice reversal off of the lows yesterday. Closed near the high. We've already broken out of yesterday's range. Got a really nice expansion going on, and we are up 1.65% this morning with an ADR of 2.6. Right, so we've got another 1% that we could easily move, and it wouldn't be considered extreme. It's that yellow line up there, 37.93. If today happens to become one of those rip your face off follow through rally days, we could tack on another 50% of this ADR. So if this is 2.6, we add 1.3 to that, and that gives us what, 3.9. Very close to a 4% move. Now, we've seen 4% moves a number of times this year, so those are not, the unicorn that they used to be. So to find that 3.9%, we'll just use our drawing tool, and that gets us around 38.40. If we were just to get absolutely wild today, we could reach that. Now, another thing of note is that we are outside of the weekly pivot point. So we're above the weekly and we're above the daily. Typically speaking, structurally, when you're above the weekly pivot point, you're in a bullish market. And I know that might seem like a little bit of Captain Obvious looking backwards kind of thing, but it really is, that simple. There's other metrics, though, that kind of come into play. I think we'll just do it this way. And it's where are the moving averages on the higher time frame. So this 50 in orange, long ways away. We're very likely not going to hit that today, right? Green, that's the 20. That's 38.40. Now that one's in play. Well, we could hit that. This light blue one is the 10. And one of them is the 10-week. The other one is the 10-day. They're really close together. We've crossed through one. Then we crossed through the other one almost in the same time frame, right? Between, say, yesterday and then in the Globex last night. So we're above both of those. If we happen to fade back this morning, old resistance becomes new support. So we're going to expect a little help from those 10s today. If you need to kind of visualize where they're at or what that looks like, just take it out to a daily time frame and then a weekly time frame and add in your moving averages. Especially, depending on, say, what broker you're using, you might not have the ability to plot daily indicators on your intraday charts. So here's the 10. You can see we crossed through it. That's what I was referencing. There's the 10 EMA, and then there's the 10 SMA. This is an EMA, but as I was showing on the chart a minute ago, we crossed through both the E and the SMA. Now we got the 20 to deal with overhead. And again, the 50 is far enough away that it's not likely to be of any concern to us at this point. Now, there's always the argument about, should I use an EMA? Should I use an SMA? And if you've got any doubt or concern, put them both on. It doesn't hurt anything. There are people who are just die-hard fans who will not move off of the indicator that they use. And both groups are massive. So it doesn't hurt to kind of get an idea of where both of those lines are. But what you're going to find is most of the time the lines are close enough together that it wouldn't really matter which one you picked. All right, so we've got our top side levels, and we've talked about the extreme. What if the market gets a splash of cold water today, right? A little bit of a reality check, and we start to tumble back down again. I'm already seeing a little bit of a head and shoulders, right? If that's the left shoulder and that's the head, and we'd be looking for a right shoulder and a neckline break and a measured move to the downside. Granted, it's an ugly head and shoulders. That left shoulder is kind of like some chewed up bubble gum, but still want to game out the theory. What if we start moving to the downside? So we'll break that 2-bar reversal, get through the VWAP. We got to get through 37.11, which reminds me the cogs are in play. When you get into 38, we got like a number of them in the 38 area. So 37.11. Why I'm not seeing a 37.11 cog, but there is one. And it's basically where we closed yesterday, right on the cog line. Then we'll work our way down through all these lower pivots. I don't think the market's going to get that cold water splash in the face, at least not yet. We were already due for a bit of a rally anyways. All right, so we made it through all of the trash that we had talked about yesterday. We are in an air pocket here, nice shallow area, and through that 3780 is when we start to get into the next volume node or volume resistance. You can see that price managed to move through this level relatively quick, and that's what we expect out of price. We can also see that there's not a whole lot of liquidity or volume where we broke through that 37.35 area, right? And the reason I'm pointing that out is, liquidity often resides on the other side of a pivot point. So as we came up into this area, if there were a lot of large orders sitting there and we had come up into it, we would have absorbed all of those orders and it would show up, right? Like a ceiling. We don't see it, at least not here. The next area of resistance, if we can get through, say, 3,800, would be 3,880. We're going to add a little bit of time to this. All right, the first VPOC that we could see is around 38.92. I don't think we're going to see that, right? This one back here, that's not a untouched point of control because once we opened, we actually did hit it. So there isn't one at 37.78. The first one that I see is all the way up here. Not likely that we're going to hit it today, but remember, that is within our measurements, right? So other than that, we are a long ways off to another one, which would be basically around 39.5. So none of those to really worry about today. We will be dealing with them on our way back up, though. We've got 3 of them. 4,000, basically 39.50, and then call it 3,900. Just about 50 points apart. It's nice. All right, gold woke up. The dollar is down near that 111 area. Bonds retesting yesterday's high, but has not managed to break through it yet. Oil's in a breakout. VIX back below 29. Why I got the dollar on here twice? There we go. Now, generally, we use Bitcoin just for kind of a risk-on gauge, right? It's a very, very risky product. So when we see that getting bid up, then we know that people are in that risk-on mood, right? And that's really the only thing I use it for. I'm not looking for any kind of correlation or anything like that. EEM is a global kind of a risk-on sentiment, and then the Bitcoin. It's really all that I'm using them for. I pointed out the other day that the dollar is not behaving the way that it has been behaving, say, over the last 4 months. That's not done with yet, so definitely keep your eye on the dollar. We do expect it to continue to fade through the week, but 110 is a really big support level, and in this fade, I don't expect it to get below 110. If it does, then we're really likely to see the S&P and the Nasdaq make some strides to the upside. I'd say S&P back above 4,000 if we start to see the dollar, back below that 110 area. It's not a perfect correlated math on that, but I'd say I'm well within the range on that. So the volume yesterday, cumulative volume, really kind of picked up, especially in the S&P. We pegged out really early, and it just stayed in that maxed out state, right? And the analogy that I use with this is when you're driving a car and you put your foot on the gas all the way to the floor. Well, sure, the pedal might not be able to go any farther, but the car continues to pick up speed. Right, and same thing here. We were kind of topping out, pegging out in this indicator, and it really just didn't have much room to go to the upside. There wasn't a lot left to move, but breadth kept increasing anyways. And it was a classic example of the C-tick, how the green line stayed in between the channel, and it just maintained that bullish posture all day. Yesterday started out with a lot of finance and not a lot of tech. And as I've been pointing out, we've had two kind of market states recently, tech and finance, or tech versus finance. Started out yesterday with tech versus finance. Later on, tech got into the game with that half-day wedge breakout, and away we went. Now, I pointed out that half-day wedge breakout yesterday, that it was too late in the day for it to be one of my half-day wedge breakouts. If it was one of mine, it would have happened earlier in the day. But shape-wise, it's exactly what the half-day wedge is supposed to look like, right? And actually, Friday was more of a classic example, even with the right time frame for the breakout. Ticks are continuing to set higher highs and higher lows after last Wednesday's move. But keep in mind with that tick that it has a ceiling, so it can't just continue to set higher highs, at which point we'll continue to focus on higher lows until there just isn't any, and then that's where we typically get a reset, right? We get that hard move to the downside, and then it starts building its way back up again. All right, I know this looks like a lot at first, but it's not that much to it. We're on a daily time frame here. We're looking at just a small amount of candles, and it's kind of the same markets that we've been talking about. S&P, Nasdaq, the VIX, the dollar, oil, volatility in oil, bonds, volatility in bonds, Bitcoin, and then some FX pairs. Now, yesterday, the Bank of Japan managed to ward off or fend off that 145 level again, and they are still adamant that they do not want to see price above that 145. So every time we get into that, we're looking for them to come in and defend that level. But at some point, they're not going to have the funds or the capacity to do it, right? We're going to get that breakout. The more times you kick the door, the more likely it is the door is going to open up. So persistence beats resistance, right? It's a nice, cute little phrase. I didn't come up with it, but I sure like it. Keep your eye on Japan. A nice breakout there after all of this struggle and fight. And if we happen to get a bit of a squeeze in there too, right? If there's a lot of shorts residing above that 145 zone and we happen to break through them, start squeezing them, could get a substantial move there. You can play FX pairs using an ETF, right? So with Japan, I think it's FXI or maybe EWJ if you want to change brands. But take a look around. You'll find country ETFs, right? And you just want to find the ETF for Japan. Go in and see what's in that ETF, and you'll realize that it's basically like a proxy for the pair, right? Very likely it'll be a short play. So Japan breaking out, going long, if you're going to use the ETF, you would be using the ETF to go short. We're still looking for the euro to get back to parity. The British pound stabilized after that Prime Minister really put her foot in it. But I don't think that stabilization is going to turn into a bullish move. So still looking for the rejection to come in. I don't see this getting above, say, 1.143. I'll be looking for that as a reversal zone. We tagged it already and failed to get through it. Might test it one more time and then flip it. A nice run back to, say, 1.1 would be a good start with an overshoot back to, say, 108. Again, if you're going to use the pair on that, you would go long if you think this is going to go short. If you're going to use the ETF, it'd be ETF long. Say like buying a call or putting on a put credit spread underneath the market. So the ETF would be long for this pair if you think this pair is going down. And I point these out for opportunities because that a lot of the market trades that we could play, say like Apple or Tesla and things like that, they're really crowded and they're really violent. I mean, the volatility and the whiplash is just, it's getting a little ridiculous out there, right? But that doesn't mean we can't participate. We just got to find something else to trade. Keep your eye on that 37.11 area. If we do get a pullback this morning, we don't want to see that pullback break below the 786, and that would put us right around 37.11. That's the cog line. That's kind of a line in the sand for this bullish move. And remember, this is not the low. It's one low, maybe a low, but not the low. We're definitely not done with the lows of this bear market. All right, so we're looking at TradingView here. I've got it switched over to how many names are bullish this morning by at least 0.5% in the S&P. 70% of the S&P is in a rally this morning, greater than 0.5%. 70%. That's pretty bullish, right? That's across the board, and that's what we want to see. We don't want just one sector kind of lifting this market up, and it can, right? Tech can do it all by itself, but it can't keep it. We want that old phrase, a rising tide lifts all boats. That's what we want, all boats. So when we come in and we see 70 names out of 100 are all rising up, the first thing I want to ask is, Well, which names aren't on the list and what sector do they belong to? Because I would be interested in that. Another number is 100%, or excuse me, 1%. So out of all the names, how many have moved 1% or more this morning in the S&P? 58. That's a really high number. So 58% of the S&P has moved 1% or more this morning. We're going to be entering into the open today in a highly correlated market state. So if you go to your market watch and you go to the visualize tab, get rid of the heat map and change it over to an index watch. And these are detachable. So you detach it, pin it so it doesn't fall behind. You can actually make these things really small. And you can load these with your own watch list or with different indexes. So the indexes are already made. You just come in and pick, the NASDAQ 100 for an example. And what you're going to want to keep your eye on first is the issues. Issues means companies. How many companies are advancing versus how many companies are declining. There's 100 names in here, so you can say it in a percentage form. If it says 97 issues are advancing, that's 97% of the NASDAQ 100 is advancing. Then you've got your volume and your capital. And I got to admit, in my world, the capital is more important than the volume. And then the put-call ratio, which I normally just block out. Right? I'm not too interested in the put-call ratio. In a highly correlated market state, you're going to have 99, 98 names all moving in the same direction. Why does this matter? Well, instead of acting like you got some kind of clue of what's going to rally today, just recognize that damn near everything is going to rally today. Pick whatever you want. It's probably going to go up. All right? Until all of the rising tide is starting to decrease. So you don't have to try to go in and nerd out and figure out what the one is. I'm sure you have a favorite. We all do. Go look at your favorite. Is it on the list? Is it one of these names that are rallying this morning? It also means that you can look at this list, and if it starts to fade, that means the rally is starting to fade. So if you open at 99 names and through the morning it drops down to like a 60-40 or a 50-50, you just lost half your market breadth. Things are either running out of steam or they're losing participants or, it's starting to fail. So it's a simple, easy metric. If you don't have this, I think you can go to like barcharts.com or INO or something like that, and they've got these kind of market breadths. I believe even Yahoo Finance and Google Finance have something like this. So if you don't have this, you can certainly find it somewhere. There is also market breadth indicators like the advanced decline line, right? The AD, NDD, or the ADSPD. That's just advancing minus declining issues. It's advance and decline. The difference is that's a graph, and it doesn't have the money in it. It doesn't have the volume flow. It's just advancing issues minus declining issues. So that's the chart form of this minus the money. We have an alpha protocol that I designed for highly correlated market states. And what we do in the alpha protocol is we trade like an algo. The algos don't go in and pick and choose, right? They'll go in and across the board, they'll buy everything. If you were to build a list of, say, your top plays, 10 names, 20 names, I don't know your account size, but your account dictates how many names are on the list. When you get into a highly correlated market state, you don't go in and try to pick a call or a put in one or two names. You buy calls in every name, and you buy puts in every name if it happens to be a correlated downward move. If one of those names on your list begins to fail or doesn't participate in the rally, it stands out really like a sore thumb Because if everything is running to the upside more than 1%, and you've got a name that isn't even participating in the move, you just get out of that, kill that trade, let the rest run. It's the alpha protocol play. Now, you want to build it to match your account size. So, maybe things that have 50-cent wide strikes or $1 wide strikes and penny increments in the options pricing, tight bid-ask spread, nice liquidity and volume in the options. It needs to match your account, right? You don't want to activate the protocol until you're in an aggressively correlated market state, right? Like 95 isn't enough. 97 isn't enough. You want 98, 99, or 100. Right? You want a very extreme correlated market state. All right, some of the biggest moves this morning is from Tesla, AMD, Nvidia, PayPal. Even good old Ford is making some moves this morning. See some banks in there. That's the S&P. Let's look over at the NASDAQ now. Same thing, 0.5%, 71. 71% of the NASDAQ is up 0.5% this morning. Then from there, 1%, 61% of the NASDAQ is up 1% this morning. And that's aggressively bullish. Look for a short covering rally this morning in a lot of those wishy-washy names, those Wall Street bets, Reddit crowds, anything that's been aggressively shorted. Look for those to get a solid pop this morning, including things like the China names, JD, Alibaba, check KWeb, like China Internet. Yeah. ARC names, anything that kind of fits that. So solar energy is up 2.75%. Semiconductors, Bitcoin, retail. You would think it's across the board, but we want to find things that are way up, right? And then things that still haven't made the move yet, but are increasing or getting better. So like regional banking, KRE, less than 1%. It's up 0.75%, but it's not like up 3% this morning. XLF, on the other hand, is up 1.6. So yeah, the good thing here is you're not going to have to pick and choose, right? That you can just go in and focus on your favorites. All right, S&P 500, set this to pre-market. Use the filter to knock it down near 100 names. Give it a color adjustment. And we can see that the fangs are up solidly and aggressively. And remember what I was talking about, tech versus finance, not this morning. Today it's tech and finance, and that's exactly what you need for one of those wow days. Just keep in mind there are a lot of Fed speakers on the docket today, and they did not want this market to rally, right? They might have wanted it to stop crashing and burning, but they didn't want it to rally. They certainly didn't want the market to think that they were going to blink or pause. And they might come out in true form today and really kind of reiterate that message of, hey, we're not done. Kind of like that old Rocky movie. I didn't hear no bell. Nobody said we were done. So if they do get that message across, we're very likely going to flip over and dump this thing back down on people's heads. Everybody, have a good morning. Be safe. Be careful. Enjoy the rip, right? Get it while you can. Just remember, in your swings, this should be a new chance to load up shorts because we sell the rip, not buy the dip, right? But on the day-to-day, yeah, run it to the upside. It's what we got.